these things have a cost. All this money printing is going to dilute the value of our dollars, and that could cause home prices to go up even more. What is going to happen? I mean, are people going to be able to afford life? If not, then that could push us deeper into a second recession. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. It feels like everywhere you look, people are talking about a potential housing market crash. CNN has come out and said that this housing market smells like 2008, and we could see another real estate meltdown. Fox News has come out and said that this could be another black swan event in the real estate market, causing the real estate market to come down. And CNBC has come out that the Fed is stroking another real estate bubble, and this could cause another real estate crash. So if you're trying to dissect away from all the emotion and really understand what's going on in the housing market, you're in the right place. So let's jump right into it. Predicting the future is nearly impossible. What I want to do for you is help you be educated about what has happened in the past. That way you can make smart decisions and understand what's going on now better than the majority of people. So let's go back in time a little bit. Let's go back in time to the year 2000. So if you remember back during the year 2000, that's when the internet started to become very popular. And back in the year 2000, this was when home prices, the average home price in America was selling for $207,000. And this was also when the internet bubble was really kind of getting really big. Then in 2001, that was when the internet bubble came crashing down. People thought that the internet was just a fad and that the internet was going to fail. And when this happened, the economy started to really slow down because everybody was losing money. Big institutions were losing money because of this internet bubble crashing. And so that's when the Federal Reserve Bank came out and they cut interest rates to stimulate the economy, because when interest rates are lower, it becomes cheaper for you to borrow money. And so these lower interest rates incentivize people to go out and buy a home, because now you could go out and buy a home at a lower mortgage rate. So 2001 was when interest rates were cut. So then between 2001 until about 2006, 2007, that's when we started to see a lot of lending restrictions loosen. Like between 2001 and 2007, we saw the growth of a lot of new lending programs. Some were the Ninja program. Some had to do with variable interest rates. And so lending became looser, which made it easier for people to qualify for a mortgage, which made it easier for people to go out and buy a home. The Ninja program stood for no income, no job, no asset loans. What that means is you could walk into a bank without a job, without an income, and without any assets to your name, and you can say, "Hey banker, I want to go out and buy this $300,000 home. What can we do?" And the banker would say, "Okay, are you gonna pay us back after we give you your money?" And if you say yes, the bank would tell you to sign the piece of paper and they will give you $300,000. That way you could go out and buy a home, because back then there were loopholes that let you buy a home without having a down payment. We also saw the growth of variable interest rate mortgages. A variable interest rate mortgage essentially says that you will get a certain mortgage payment today, and this might be a very low payment because the banks will try to incentivize you with a teaser interest rate, which means for the next 5 years, you are gonna have a super low mortgage rate, and then after 5 years, the mortgage rate is going to readjust based on what interest rates are after 5 years. And if interest rates go up, then your mortgage payment would go up, and if interest rates go down, then mortgage payments would go down. And so people were getting really attracted to these variable interest rate mortgages, because now you could buy a home with almost no money down, and then you can have a very low monthly payment thanks to the help of these variable interest rate mortgages with very low teaser rates. So now you just buy a $500,000 home with almost no money out of your pocket, and your monthly payments are what you were paying for a rental on a $200,000 home. These two lending practices helped a lot of people go out and buy a home, even though they weren't necessarily qualified to buy a home. But because everybody was making so much money, nobody ever thought that the housing market could come down. And so banks were qualifying everybody, and so everybody was going out and buying a home. And then around 2006, that was when we really started to see mortgage rates start to go up. We saw it start to happen in 2005, but it got more severe in 2006 and into 2007, because during this time, we saw interest rates go up. And so now when people were buying a home back in the early part of the 2000s, now their new mortgage payments were way higher. You started off paying $900 a month, and maybe you were living paycheck to paycheck, but you had this massive mansion and you thought that your home was gonna make you rich. So you invested a ton of money into your home, and then come 2006, 2007, and now you find out that your $900 monthly mortgage payment is going up to $2,700 a month. You can't afford $2,700 a month when you were used to paying $900 a month. So what do? Well, what every banker said was that at the end of your teaser rate, at the end of 5 years, what you can do if mortgage rates really go up is just refinance into a new fixed rate mortgage, and then you won't have to worry about interest rates going up anymore. But that means that in order for you to do that, you have to be able to actually refinance on your home, which means you have to assume that home prices will continue to go up. And so what started to happen here is home prices stopped going up. They didn't keep going up the way that they were before. In 2007, the average home in America was selling for $314,000. So we're talking about a 50% jump between 2000 and 2007. Just 7 years. That's pretty crazy. But now, at this time, home prices stopped going up. And so people who were buying homes with little to no equity had a very tough time refinancing, because now their mortgage payments went up because this teaser rate expired, and then they couldn't go out and refinance their mortgage because now I found out that, okay, I bought a home for $300,000 and now I want to refinance, but now my home is only worth $280,000. So I can't refinance, because if I wanted to refinance, I have to pull out another $20,000 out of somewhere, and I don't have $20,000. So now you're left with a super high monthly mortgage payment. You cannot refinance and you cannot sell, because if you sell your home when you're underwater, you're gonna have to bring cash to the closing table to pay off your bank, and people didn't have the cash to do that. So now all of a sudden, you had a huge chunk of America that was underwater on their homes with payments that they cannot afford. So people cannot refinance, they cannot sell, they don't have a way out. So then came 2008, and in 2008, that was when this housing bubble imploded. This was when the Fed came out and they started cutting interest rates, and this was when the entire system came crashing down and home prices started to crash, because this was the time that everybody started to realize that I cannot afford this massive home that I owned. And so now you started to see foreclosures happen left and right. You started to see big bankruptcies happen left and right. You started to see huge bailouts happen left and right. And the effects of this crash happened a long time, because the real estate market is a slow moving market. It's not like the stock market where somebody can panic sell and then you can see a massive crash happen in one day and then you can see a rebound the next week. It doesn't work like that in the real estate market, because real estate is very slow moving. I mean, it can take you anywhere from a week to a year to sell a property. And so we saw this crash happen in 2008. This is when real estate prices came crashing down. This is when the stock market came crashing down. And in 2009, I know my lines are getting messed up in terms of spacing, but just understand this is 2009. This was when the stock market bottomed. So we'll put the stock with a low arrow there. In 2009, that was when the stock market bottomed, but the real estate market kept going down. It wasn't until 2012, I'll say this is 2012, when the real estate market eventually bottomed out. In 2012, the average home in America was selling for $110,000. Compare that to 2000 prices when it was selling for half of that, and compare that to 2007 prices when it was selling for almost a third of that. So 2012 was when the real estate market completely hit its bottom, and this was when real estate prices finally started to stabilize and then start to turn around and go up again. Now, if we come on a new line over here, so we'll start this at 2012. Between 2012 and 2019, I know my spacing is off, but just understand the dates. Between 2012 and 2019, this was when we started to see a real boom in the housing market. Well, not really a boom, but real growth in the market. Steady growth, because now the economy started to recover, people started to get their incomes back, people started to become credit worthy again, and so now people finally started to go out and buy a home, and so we started to see home prices go up. So home prices went up, and at the same time, more people became homeowners because people were finally able to qualify for a mortgage again. And during these years, 2012 to 2019, we started to see interest rates go up slowly. So between 2012 and 2019, we saw interest rates go up. And then in 2019, something interesting happened. This was when Donald Trump was in office, and the economy started to slow down, and it started to show red flags of a slowing economy and a weakening economy. So that was when the Federal Reserve came out, and they preemptively started cutting interest rates again to incentivize people to borrow money and to spend. This is very strange, because typically you only cut interest rates when you're in a recession to stimulate the economy, because now the economy is already slow. That's why we saw interest rates cut in 2001, we saw interest rates cut in 2008, we had the dot-com bubble here, the housing market crash here. And so typically you only see interest rates cut when you're trying to stimulate the economy because you're in a recession or something bad happened. In 2019, we kept hearing about how we're in the strongest economy of all time, but because we started to see these red flags, that's when the Fed came out and they cut interest rates to get the economy booming. So this helped more people to go out and buy a home even more. So I'm gonna just extend this out here because this helped the housing market even more, because now it became cheaper for you to go out and buy a home because mortgage rates dropped. Then came the year 2020. Oh baby, we all remember 2020. 2020 was when the pandemic happened, and in 2020 everything changed. In March, the economy shut down and the Federal Reserve Bank slashed interest rates to brand new lows, next to zero. And so now we saw interest rates come down significantly. So we saw interest rates start coming down in 2019, we saw them come down significantly in 2020, and now all of a sudden it became a whole lot cheaper for people to go out and buy a home because mortgage rates were way cheaper. So in the early parts of 2020 into mid 2020, maybe even fall of 2020, it was very cheap for people to go out and buy a home because home prices didn't really start booming until the later part of 2020. And so the people that were buying homes when mortgage rates first came down got a huge deal because now home prices were still relatively reasonable. And on top of that, mortgage rates were so low, so people were going out trying to take advantage of these low mortgage rates. And now all of a sudden you had this huge influx of buyers come into the market, and you didn't have a huge supply of homes available for sale because some people didn't want to sell their homes because of the pandemic. You had this labor supply shortage, you had the price of lumber starting to go up, and so you had a lot of issues which restricted the supply of homes available for sale. On top of that, you also had government regulations, the government forbearance program, and the eviction moratorium, and the foreclosure moratorium, which stopped banks from foreclosing on homes. So you had a limited supply of homes available for sale, and at the same time everybody wanted to buy a home. So in the second part of 2020, that's when we really started to see home prices boom. In 2021, things got even more interesting because in the early part of 2021, the Fed said, you know what, I think the economy started to recover, so the Fed started to raise interest rates in the early part of 2021. So in February, March, and even the early part of April, we saw interest rates go above 3%. We saw mortgage rates go up to around 3.3%. Then the Fed got concerned again. They said, you know what, maybe our economy is not ready for this. Maybe our housing market is not ready for this. Because as soon as interest rates started to go up, people stopped buying homes the way they were doing before, and they were worried that if they slowed the economy down right now, when we're still in a recession, when we're still in the recovery mode, this could destroy everything. And so that's when the Fed backtracked, and that's when you started to see mortgage rates start coming down again. So in April and May and even into June, that's when you started to see mortgage rates go back down below 3% a year for a 30-year fixed rate mortgage. That means you can go out and borrow $500,000 for 2.8% on a 30-year fixed rate mortgage. So this continued the housing boom in 2021. And now the question is, how long can this boom really last? Because the reality is nothing can go straight up forever. Not the stock market, not cryptocurrency, not real estate. We saw that happen back in 2008. So how long can the housing market keep booming like this? Because we have the housing market growing like this, and we have the rest of the economy growing like this. So the question now is, how long is this gonna last, and what's gonna happen after the housing market starts to slow down? Because eventually we're gonna get to a point where there's gonna be less buyers, maybe even more sellers. And so what happens then? Let me start by pulling up the CNBC article where you have the billionaire Jeff Green, who made his fortune by shorting the housing market back during the 2008 crash. In the mid-2000s, when everybody thought that the housing market couldn't slow down, he came and he started shorting the housing market, and it made him very rich when the housing market collapsed. He came on to CNBC and he says that the housing market is, quote, a bubble once again. And then when he was asked how long is it gonna last, he said it depends. How long do you keep the faucet open and there's money running? So it's very interesting that he said that, because he brought up some very kind of concerning points. First, on the economic level, the thing that has been really boosting the United States economy since this pandemic and recession started has been the housing market. Because according to this article, the housing market has been one of the strongest parts of the United States economy during this pandemic. And the thing that's been boosting the housing market is obviously low mortgage rates. Mortgage rates have been historically low, and with the rise of remote work, everybody wants to own a home with an office, so people have been looking for a new home to live in. That way they can work from home and maybe never have to go back to the office, or if they do, it'll be a hybrid model. And then on top of that, not only is he worried about a bubble, he's also worried about inflation. I'm going to read you this quote because this is a very interesting thing that he said. He says, quote, "I think we're going to have inflation that no one is forecasting whatsoever, and it's going to have to lead to much higher interest rates, and that is going to slow down all of these markets." So essentially what he's saying is that because of all the money printing that we did, because of all the stimulus that we put out, this has boosted the housing market in the short term. But in order to save our economy for the long term, we're going to have to see a huge rise in interest rates in the future. And when that happens, it's going to slow down the markets, which means he thinks that it's going to bring the housing market back to earth. And along with that, probably other asset classes too. The stock market, cryptocurrency. Now, just like how I don't want you to blindly listen to me, a random guy on YouTube, I also don't want you to blindly listen to him either, because everybody could be wrong. And so I want you to just understand what's going on and why people are concerned. That way you can make an educated decision for yourself. What he's saying essentially is we have very different factors now than we saw back during the 2008 crash. The short list of factors that led up to the 2008 crash were the ninja loans, which meant anybody could go out and get a mortgage even if you didn't have any money or a job, and the variable interest rate mortgages, because it put your mortgage payments on a very kind of variable thing, because if mortgage rates went up, then your mortgage payments went up, and nobody really understood how variable interest rate mortgages worked. So you had tons of people jump into them because of these low teaser rates, and then when interest rates went up, they couldn't afford the mortgage payments anymore. We're not seeing those same issues right now. There are still hurdles you have to jump over in order to get a mortgage. You have to have a job, you have to have a down payment. And on top of that, you're not seeing the growth of these variable interest rate mortgages the same way you did before. Do they exist? Yes. Are they as popular? No. Most people who are going out to buy a home or refinance their home right now are taking out a 30-year fixed rate or a 15-year fixed rate mortgage, which means that for the next 30 years or 15 years, it doesn't matter what happens to mortgage rates, your payments are going to stay the same. So even if interest rates shoot up, or even if home prices go down, your monthly payments, how much you have to pay, is not going to change. So you don't have the same risk factors now as you did before, because even if mortgage rates go up, the vast majority of Americans are not going to see any change in their mortgage payments unless you refinance or unless you go out and buy a new home. Now, there are other factors out there right now that are artificially skewing this housing market in one direction. For example, we still have a labor shortage and a material shortage. It is hard for construction companies to go out and find labor to work on homes or to renovate homes because of all the stimulus that was going on, because some people are scared to work, and because of some of the unemployment benefits that still exist. And so these construction companies are now having to pay their labor more, and because of that, there's a higher cost to build homes, there's a higher cost to renovate homes, which is pushing the price of homes up. On top of that, we also have a material shortage. Lumber prices have skyrocketed over the last year. And so if you want to go out and renovate a home, or if you want to go out and build a home, it's costing you way more now than it did just 18 months ago. Why? Because the cost of materials is so much more expensive. I mean, even if you just walk through Home Depot, the cost of things are way more expensive now than it was just a year and a half ago. Because of that, it costs a lot more money to build a home, which is also pushing home prices up. The hope is once the supply chains start to normalize, and once the economy goes back to normal, and once more people go back to work, the cost of materials and the cost of labor will start to go down and normalize a little bit. But we don't know when that's going to happen and if that will happen. So that's just something we got to keep an eye on, because if that doesn't happen, that's going to keep home prices higher. The next thing you got to look at is just how accessible is money. And this looks at mortgage rates. If mortgage rates stay low, it will keep incentivizing people to go out and buy a home, because now you can buy a home at a very low mortgage rate. A 30-year fixed rate mortgage at 3% interest is unheard of, or at least it was unheard of before this 2020 pandemic and recession, but it is a historically very, very low rate. And so if you can go out and buy a home at a fixed rate mortgage, or if you're refinancing your home at a fixed rate mortgage, well, now you have just locked in how much money you have to pay for the next 15 or 30 years. One of the only guarantees that we have in the housing market is that eventually mortgage rates will go up. When will it happen? I don't know. But if you are capitalizing on these low mortgage rates, whether you're going out to buy a home or if you're going out to refinance your remortgage because you already own a home, you can capitalize on these low mortgage rates, because what we know right now is that mortgage rates are going to go up, which means the cost to borrow money is going to go up. The people that this is going to affect the most, or the people that need to take advantage of this more than anybody else, are people that own their home right now that have not refinanced yet. Because if you have a mortgage on your home, you're already paying money to borrow this money, right? That's what your mortgage rate is. But if you haven't refinanced, that means you have not taken advantage of these lower mortgage rates. If you own a home, what you need to understand is that mortgage rates will go up. So you might as well take advantage of these low mortgage rates while you still can, because these low mortgage rates are not going to stay around forever. The Fed has already tried to raise mortgage rates in the early part of 2021, and then they brought them back down, but now they're talking about trying to raise mortgage rates again. So if you have not refinanced your mortgage and taken advantage of these low mortgage rates while mortgage rates are historically low, you want to make sure you do that. That way you can capitalize on these low mortgage rates and have a fixed rate mortgage, because now all you're doing is borrowing the same amount of money and paying less money in interest. When you go out to refinance or you look for a lender to get a mortgage, just make sure you shop around, because some lenders are going to charge you a whole lot more for the exact same loan. If and when mortgage rates start to go up, the worry that a lot of economists have is that people are going to be less attracted to the idea of going out to buy a home, because now if you want to go out and buy a home prices are up here, and on top of that, mortgage rates are starting to go up, so owning a home becomes way less affordable because prices are way up here, but with low mortgage rates it kind of balances out. But if prices are up here and mortgage rates go up too, now all of a sudden it has become way more expensive to buy a home because you have high home prices and high mortgage prices. If that happens, now many people are going to be priced out of the housing market and they're not going to be able to buy a home. If you have less buyers out there and you start to see more sellers, then that could start to correct the housing market, because people just can't afford to buy a home. And if that happens, you could see a home price correction. That doesn't mean a home price crash. A home price correction just means bringing home prices back down to earth so people can afford to buy a home again. But the real underlying factor, the backbone that we have to look at for the housing market, is really the economy. Because if the economy is slowing and if people don't have jobs and if people don't have an income, then they don't have money to go out and qualify for a mortgage, and they don't have money to make the housing payment. And so we have to understand how the economy is working. We also have to factor in inflation, because inflation is definitely something you want to pay attention to when we talk about the long-term health of the economy. Our economy in mid-2021 is way better than it was in mid-2020, because in mid-2020, half of America was shut down. In mid-2021, things are definitely starting to get back to normal. People are definitely starting to go back to work, and the economy is starting to recover. But in mid-2021, the economy is still nowhere near where we were back in mid-2019 or mid-2018. So our economy has recovered some, but it is not even close to fully recovered. Our economy, at the time of me recording this video, is still relying on the government in order to survive and function. Like right now, at the time of recording this video, you still have dozens of states that have added unemployment benefits, which are helping people who are unemployed, but it's hurting businesses because businesses are struggling to find people to work. The thing that you're going to want to make sure you pay attention to over the next 12 to 18 months is what happens when the government stimulus programs end and when the government free money ends for people and for businesses. Once that happens, what are we going to see happen in the economy? Are people going to go back to work and is things going to go back to normal? Or are people going to go back to work and now people are having a tough time affording life because of all this new inflation, and so now they can't afford to go out and live a normal life? If that happens, we could see a slowing economy. The second thing you want to pay attention to is what happens when all the government stimulus for the housing market starts to slow down. Like what happens when the forbearance program ends? What happens when the mortgage moratorium ends? What happens when the foreclosure moratorium ends? What happens when the eviction moratorium ends? When the government regulations stop and now you can start to see foreclosures happen again, or people have to start making their mortgage payments again, or when people can be kicked out of their homes for an eviction again. What's going to happen then? Right now, you have a lot of people that are not paying their mortgages because of the mortgage forbearance program, but a lot of those people are not paying because they don't have to. Some of these people are paying because they're in a hardship, but a lot of them are paying just because the government says that you don't have to pay your mortgage right now. So what happens when people have to start paying their mortgages again? What happens when people have to start paying their student loans again? What happens when now, if you are a tenant or you have a private mortgage that you got this forbearance program on, and now your bank or your lender or your landlord says that you have to make up all your back payments? What's going to happen then? And so this is what I don't have the answer to. I mean, maybe we could see a wave of foreclosures, maybe we won't. And so this is what we have to understand, is that the economy is the underlying backbone of the housing market. Because yeah, if people can go out and borrow money cheaply, you're going to see a huge influx of buyers. But at the same time, you're not seeing foreclosures, you're not seeing evictions, and people don't even have to make their mortgage payments. And so people have a lot more money in their pockets right now just because that's the way the system is working. We have this kind of market equilibrium that's being skewed. In a normal market and a normal economy, you see something called market equilibrium, which means that if home prices grow too fast and people can't afford homes anymore, you're going to see home prices come back down to earth. But right now, you're not seeing that because there's a lot of government intervention which is preventing this market equilibrium from happening. Some people have a lot of money in their pockets because some people were very benefited by this pandemic and recession. Some people did not lose an income through this pandemic. Maybe they lost their jobs for a little bit because their whole company shut down when the whole country shut down, but they were getting big unemployment checks, so they never really lost an income. And then they went back to work, and then on top of that, they also got stimulus checks. Thousands of dollars worth of stimulus checks. So now you got this extra free money. And on top of that, maybe the value in your home shot up because everybody was buying homes. So now you could do a cash out refinance. And now you have more cash in your hand while your mortgage payments have not changed because mortgage rates went down. So now you got the stimulus money, you got this cash out refinance money, and other people just went into mortgage forbearance. And now instead of you paying $1,800 a month on your mortgage, that's $1,800 a month you can put into your investments, or that's $1,800 a month that you can spend on your savings, or that's $1,800 a month that you can spend on shopping. Time to get some extra guac. Now, from a smart financial perspective, I don't want you to take the extra $1,800 and just spend it. I want you to be smart with your money. That means either paying down your debts, saving this money, or investing your money, or just paying down your mortgage, right? I want you to be smart with your money, but you have a lot of people right now that have extra money thanks to the help of this pandemic. Now, yes, there are some people that were really hurt by this pandemic. If you work in the hospitality industry, if you work in the restaurant industry, some industries were really hurt hard by this pandemic, and maybe you didn't get the benefit from the unemployment programs or the stimulus programs like other people were. So some people were really hurt by this pandemic, while other people were really benefited by the pandemic. And so what we have to understand now is that going forward, once the government stops giving out free money, what is going to happen to our economy? Are things going to go back to normal, whatever normal is? When that happens, what is going to happen? I mean, are people going to be able to afford life? If not, then that could push us deeper into a second recession. If people continue to grow their incomes, if we continue to see wages rise and we continue to see unemployment go down, which means more people have jobs, then this can continue to help the economy grow. And if that happens, we're going to have more people that will continue to be able to go out and buy a home. So if we have more people who are doing good in the economy, even if we have mortgage rates start to go up, it's not going to be too big of a deal because people will have money to go out and qualify to buy a home. But if we start to see people go back to work, and now all of a sudden people are back to work, and life is so expensive because rent is so expensive, your groceries are so expensive, gas is so expensive, vacations are so expensive, and you cannot make ends meet from just your job, then you're going to see less people inclined to go out and buy a home. And if around that time you start to see the mortgage forbearance program end, and you start to see the student loan forbearance program end, so now people who had a lot of money over the last year and a half because they didn't have to pay money to the student loans and they didn't have to pay money to their mortgage, now all of a sudden have to pay the mortgages and their student loans, so they don't have money to go out and spend, they don't have money to go out and travel, they don't have money to just go out and enjoy. Now you're going to start to see the economy start to slow down again because you have less spending happen, right? Our economy runs on spending. The more that one person spends, the more that somebody else makes. And so when we're looking at the economy, there's a lot of different factors that you have to pay attention to. The main concern that a lot of people have is just what's going to happen with this new inflation, because we printed so much money in 2020 and 2021, which has diluted the value of our dollars. Now, on top of that, we have so many people still relying on the government to survive. So when this government aid ends, and now people have to rely on themselves to survive, and on top of that, we have this higher inflation, which means a higher cost of living. If people cannot afford this, that will hurt the housing market because now the whole economy is hurting. Now, at this point, this is where everybody starts to wonder, okay, Jaspreet, should I not go out and buy a home? Should I not sell my home? Or what should I do? The thing that I want you to remember is that nobody can accurately predict what's going to come next, and if they do try to predict what's going to come next, nobody knows when that's going to happen. So what I want you to do is when you make your decisions, whether it's to buy a home or sell a home, is make your decisions based on smart financial education, and don't base your decisions based on a potential housing market slowdown that could potentially happen at some point in the future. If that happens, we don't know when it's going to happen, and if it happens, we don't know how severe it's going to be. So what I want you to do is, if you're going out to buy a home, just make sure you can afford the home. That means afford the down payment and be able to afford the monthly mortgage payments. That way, even if the housing market slows down, or even if we see a housing market crash, you'll be okay because you can afford your monthly payments. And if you're thinking about selling your home, just make sure it makes sense for you. Is this a good time for you to sell? Do you have another place to go? So when it comes to making your own personal finance decisions, make your decisions based off of what's right for you using smart financial education. Don't make your decisions based off of a potential crash or fears of a crash, because no one can accurately predict that. Ever since this pandemic hit, Our housing market has been booming because the Federal Reserve Bank slashed interest rates, which made it cheaper for you to go out and buy a home because now mortgage rates were so much lower. Now, this was kind of a strange situation to see because the United States entered a recession, and at the same time we entered a recession, we also entered one of the biggest housing market booms that we have ever seen in history. And so we have our economy that's struggling, but we have some people that have the cash to buy a home, and this is causing home prices to go like this while the economy is on real choppy waters. Now, to make matters a little bit more crazy, we have some new proposals out right now which could take a housing market to new insane levels. And so you got to understand what's going on, and that's what I'm going to be talking about in this video. But before I do that, I need you to do me a quick favor and smash that thumbs up button below. Here's the agenda for today. I'm going to start by talking about what's happening so we're all on the same page. Then I'm going to get into the forbearance program because there might be some major changes coming to our forbearance program which could drastically change our housing market. Then I'm going to be talking about equity. This is important to understand. Number 4, the housing bubble, because some people are talking about a potential housing bubble, so you want to understand what's going on with that. And then number 5, I'm going to be talking about my thoughts with what could be coming in the future. So let's jump into it. Between 2020 and 2021, we saw the median wages in the United States grow by right around 3%. At the same time, we saw housing prices between March 2020 when the pandemic hit and March 2021 grow not by 3% but by 15.6% in just 12 months. And I'm talking about the median home prices in America here. Generally, you want to see home prices grow at the same rate as wages, because if home prices are growing like this while wages are only growing like this, eventually you are going to hit a tipping point. Eventually you're going to hit a point where buyers can no longer afford homes. Because if housing prices keep going up like this, eventually, right, you're going to hit a point where your income is not going to afford new home prices, and so buyers are not going to be able to buy homes, and this would cause a housing market correction, because if people can't afford homes, then home prices have to correct, not crash, but correct so people can afford homes, and then this would eventually hopefully cause the housing market to go back up. But a few things that have been fueling this housing price growth between 2020 and into 2021 has been low interest rates, because in March 2020 we entered this recession and pandemic, and so the Federal Reserve Bank slashed interest rates, which made mortgage rates drop, and so everybody was trying to buy a home and take advantage of these low interest rates. And second, we had a super low inventory of homes available for sale. So you had all these people that wanted to buy a home and not that many people selling homes, and so everybody who wanted to buy a home went out and they were fighting each other to buy a home. At the same time, we had this mortgage forbearance program created because now you had a lot of people that didn't have money to make their mortgage payments. Typically what would happen, we saw this happen in 2007 and 2008 and 2009, if you cannot make your mortgage payments, the bank is going to come in and they're going to take your property away from you. They're going to foreclose on you. But the government stopped that from happening. And so now you had a lot of people that weren't selling their homes. So you had a low supply of homes available for sale, and you had a lot of people that can't afford their housing payments, but they're not getting foreclosed on because of the forbearance program. So now we've created the perfect storm in the housing market because we have super low mortgage rates. We have a small inventory of homes available for sale, and at the same time we have a ton of people that want to buy homes. All of these things together have been pushing home prices through the roof. Literally. This brings me to the issue that we're facing right now, forbearance. So back in 2020, the government created the CARES Act, which allowed people who had a government-backed mortgage to put their mortgage on hold through the forbearance program. Essentially, whether you're facing a financial hardship or not, you could put your mortgage on hold for up to 18 months. They kept extending it, but up to 18 months, which means that the mortgage forbearance program, assuming that you entered into it when it first started, you would be ending in around September, October of 2021. And now it looks like they might be extending this forbearance program again. And at the time we're recording this video, we have right around 2.6 million Americans, this is 2021, that are in forbearance on their mortgages that are not paying their mortgages right now. To put that in perspective, if 2.6 million people were foreclosed on today, because these are the people that are not paying their mortgages right now, we would see an all-out economic collapse. If this were to happen today, our whole entire economy would completely melt down. Because if you remember back in 2008, when the 2008 crash happened, there were right around 3 million people that got a foreclosure notice, but right around 860,000 people were actually foreclosed upon. So in 2008, 860,000 foreclosures caused our entire economic system to almost fail. Now we have 2.6 million people that are not paying their mortgages, and so the government is naturally concerned because nobody wants a repeat of 2008. But there are some differences between now and 2008 because this forbearance program is voluntary. And so you have a lot of people in this forbearance program right now that are not paying their mortgages because they're thinking, well, I could pay $1,500 a month to my mortgage, or I can just put my mortgage on hold and I can take this extra $1,500 and invest it in the stock market. Or I can take this extra $1,500 and put it towards my savings. Or I can take this extra $1,500 and go shopping. If you have a government-backed mortgage, there is nearly no requirement for what you need to do in order to apply and get approved for this forbearance program. All you have to do is say, I want to forbear my mortgage, and now you don't have to pay your mortgage payments anymore. So you don't have to have a financial hardship to apply for this forbearance program, which is why we don't know out of this 2.6 million people, how many people are not able to pay because they're facing a financial hardship, and how many people are not paying because they just don't want to. I mean, you have financial advisors out there that are telling people, hey, put your mortgage on hold and take this money that you would have been paying towards your mortgage and put it towards your investments, put it towards your debts or your savings or whatever, because you don't have to pay your mortgage right now. And so some people here are trying to take advantage of that. But now the thing that's making this even more interesting is the new proposal. So I just cleaned off my whiteboard so I can diagram what's going on. But the CFPB, or Consumer Financial Protection Bureau, has put out a brand new proposal that will do three things to help out the 2.6 million Americans that are in forbearance right now. The first thing they want to do is they want to give borrowers more time to come up with a plan on how they can recover on their finances after the forbearance program ends. And so what they're proposing is no foreclosures until 2022. Essentially, they're saying that you cannot file a foreclosure on somebody until after December 31st, 2021, which means you will not be able to foreclose on anybody until 2022. But this rule only applies to primary residences, which means if you have an investment property, this does not apply to you. The second thing they want to do is give you more options. That way you have more ways to kind of get out of your forbearance program without real financial hardships. And so they don't want people to end their forbearance program and they get slapped with late fees or fines or huge lump sum payments. And so one of the options is actually going to really shake up the housing market, because one of the things that they're proposing is to give borrowers who are facing a hardship because of this pandemic to now extend their mortgage to a brand new 40-year mortgage. So if you took out a 30-year mortgage and you've been paying your mortgage for, let's say, 5 years, now you have 25 years left on your mortgage, and now you're in forbearance, what you can do is you can start your mortgage process all over again if you can show that you had a financial hardship, whatever that means. This is up to you to decide. But if you can say that you had a financial hardship, now you can start your mortgage all over again with now a 40-year term instead of a 30-year term, so you can have smaller monthly payments, and your bank is not allowed to charge you any interest or any fees in order to do that. So your interest rate would stay the same. All your other fees and stuff would stay the same. They cannot tack on more fees. And now you can start your mortgage all over again with lower monthly payments, because now you would have a 40-year mortgage instead of a 30-year mortgage, and you would keep the exact same interest rate you have today. The reason why this is such a big deal is because of two reasons. First, it can really change how much your monthly payments are. I'll show you. If you owe $400,000 to your bank and you had a 15-year mortgage, your monthly payment is going to be right around $2,800, $2,900 a month. But if you had a 20-year mortgage, now your payments drop down to $2,300 a month. If you got a 25-year mortgage, now it's $2,000 a month. And if you got a 30-year mortgage, your payments would be right around $1,800 a month. But if you had a 40-year mortgage, your payments would drop down all the way to $1,550 a month. So some people are going to be saving $1,000 a month if they change their mortgage to a brand new 40-year term. The second reason why this is so important is because it doesn't just apply to federally backed mortgages. It also applies to private mortgages. So the original forbearance program and the CARES Act was only applying to mortgages that were backed by the government. FHA, USDA, VA mortgages. But if you had a non-government mortgage, a private mortgage, a conventional mortgage, then you weren't able to get the same forbearance plans that other people had. this program would allow you, whether you have a private mortgage or a government-backed mortgage, if this is passed, to now get the same options. And the reason why this is so significant is because if you have a private-backed mortgage, then some lenders can come to you and say, all right, you haven't made payments for the last 12 months, you owe us all this money right now. And so if people can now start a brand new mortgage without paying any fees, keep the same interest rate, and now extend their mortgage for 40 years, then people could save $200 to $1,000 a month. And now this could help grow the economy even more because people will have more money in their pocket, which means now they'll have more money that they can use to go shopping and go stimulate the economy. Now, I'm not saying this is what you should do. This is just how the system thinks and works. So if this proposal is passed, you have to imagine that this is going to be a pretty big chunk of people that are going to apply for this brand new 40-year option because they'll be able to keep more money in their pocket. You'll be in debt for the next 40 years on your mortgage, but if you can save money every single month, now you're also going to have a new group of people that might not want to sell their homes because you're not going to get that same kind of cost of ownership in a brand new property because home prices keep going up and interest rates are starting to go up. And so you might be staying in your home for a long time now because you got the benefit of a low interest rate. You can extend the life of your mortgage. And now you might want to stay in this property, which means we're going to have a small inventory of homes continue to stay available for sale because we can't have foreclosures. And now people might not want to sell their home. But I'll get more to that in a little bit. And the third thing that this proposal talks about is that banks will have to keep you up to date as a borrower as to what your options are. So even if you weren't aware that you could take this new mortgage of 40 years, the bank is supposed to tell you that if you are facing a financial hardship. So if this gets passed, banks might be required to ask you if you faced a financial hardship because of this pandemic, and if so, then banks might have to give you different options on how you can pay back your mortgage. The third thing that I want to talk about is equity, because when home prices are going up, this is very good for homeowners, but it's not so good for people who want to be homeowners, because now if you are a homeowner and home prices keep going up, you just found brand new wealth because now you have more equity, at least on paper. Now you don't actually keep this wealth or have this cash in your hand unless you sell your property, or I guess unless you refinance and you pull out some cash. But you don't actually see that money until you actually do something. Now, if you want to be a homeowner, rising home prices are bad news because now it's going to cost you more money to be a homeowner. If you really want to understand the housing market, you have to pay attention to equity and how much equity people have in their homes, because one of the reasons why the 2008 crash happened was because people had no equity in their homes. And so when people have no skin in the game and housing prices fall and they can no longer make the monthly mortgage payments, they have no incentive to not walk away because you're already underwater in a home and now you can't afford the monthly payments. So what's the point of staying in a home and keep kind of going deeper and deeper into debt when you can just walk away? And so if people have equity in their homes, then they're going to be much less likely to walk away. Now, I'm going to talk more about that when I get into number 4, the potential housing bubble that everyone's worried about. But the thing that I want you to understand about equity right now is we have this refinance boom going on, which can be good or it can be bad, and it just depends on what you're doing. There are 2 big reasons for why somebody would want to refinance their home. One is if interest rates fall and now you can save money on your mortgage. And second is if home prices go up and somebody wants to pull out some cash from their home. Mortgage rates right now are still at historic lows. They're not as low as they were a few months ago, but they're still historically very low, which means if you took out a mortgage a year or 2 ago or any longer than that, then you could save a ton of money on your mortgage just by refinancing into a new, cheaper loan. Now, at the same time, many people have been refinancing because they saw that their $200,000 home is now worth $250,000, and so now they want to pull out some cash. Now, this can be good. It just depends what you do with this cash. If you are an experienced investor and now you're pulling out this cash because you can get this cheap debt and you're going to use this debt to go out and buy a rental property, or you're going to use this debt to invest, that way you can make more money, that is a good use for your money. But if you are refinancing a home, pulling out cash from your home, that way now you can go out and go on a shopping spree, that is a big no-no. In general, if you want to refinance your home and you want to be debt-free as fast as possible, then you want to pull out the least amount of cash as possible, and then you want to work to pay off this debt as fast as possible. So if you're in that situation, then what you want to do is you want to refinance into the lowest interest rate possible. That way you can pay the least amount of money on your mortgage and keep more money in your pocket. That way more money is going to build your wealth instead of just your banker's wealth. The thing that I'm worried about here is we do have a lot of people that are pulling out cash from their homes, which is not necessarily a bad thing. But now it's what do you do with that cash? And this is something we're going to see more into next year and the year after that. But if people are pulling out this cash and they're doing, let's say, not financially smart things with this cash, this will help the economy in the short term. but over the long term, that could cause more issues if people do not have equity in their homes. Because if people do not have equity, or they have very small equity, and the housing prices drop, now all of a sudden people were doing really great because they had this newfound equity and just pulled this cash out, and now if home prices drop, I'm not saying this is going to happen, I'm saying this is a big if, but if home prices do drop and people have no equity, now this could make a bad situation worse. So this is something I just want you to pay attention to, because we're seeing more and more programs that are allowing people to buy homes with 3% down, and in some situations even 0% down. And so you want to pay attention to how many people are buying homes with equity and how many people are buying homes with no equity, because if you see more and more people buy homes and they have no skin in the game, then that's something you kind of want to be a little bit concerned about, because if people have no skin in the game, then they're gonna feel like they have nothing to lose. Now, before I get into this potential housing bubble that everybody keeps talking about, I do want to say another thing about refinancing, because if you are interested in refinancing right now, this is still one of the best times in history to refinance, but you don't want to wait too long, because if interest rates keep going up, then you might miss out on the great interest rates that you have right now. So if you are interested in refinancing on your mortgage, don't wait too long and wait for interest rates to go up even more, because the lower interest rates are, the more money that you can save. And one of the best ways that you can save money through a refinance is just by shopping around, because some lenders are going to charge you a whole lot less for the exact same loan or refinance. Now let's get into the topic that many people have been talking about, a potential housing bubble that is building right now. A lot of people like to compare 2021 and 2020 to 2008, because they say, okay, in 2008 you had 3 million people that were not able to pay their mortgages that received a foreclosure notice. In 2021 right now, like I talked about, you have 2.6 million people that are not able to pay their mortgages. Now, there's a big difference between what happened in 2008 and what's going on in 2021. Back in 2008, you had a lot of things building up, because back before the 2008 crash, people were not able to afford homes. That's similar to what you're seeing now. But what happened was banks started creating these new programs such as ninja loans, no income, no job, no asset loans, letting people who have no money buy a home. You could buy a home with little to no down payment at all. And then on top of that, because you couldn't afford the home, you had these low variable interest rates, and these variable interest rates came in with these very low teaser rates. So you could come in, buy a home with no money down, and your monthly payments for the first 3 years were super cheap, maybe even 5 years, depending on what mortgage you got. And so you had a lot of people buying homes without really understanding their mortgages. And then once this variable interest rate started to hit and their mortgage payments started to go up, now all of a sudden you had these people that had no equity in their homes and had these super high mortgage payments that could no longer afford their payments, and so people just started walking away. What we're seeing right now is similar but very different at the exact same time. And so right now, we still have a lot of people that are struggling to be able to afford a home, kind of like what you saw happen in the mid-2000s. Now, the way the banks and our systems are working to help people buy homes is very different than before, because now we don't have those ninja loans. We don't have a lot of people getting variable interest rates, thankfully. They are starting to come back, but we don't have a lot of people getting variable interest rates. And so people are buying homes with fixed rate mortgages, which means if in 5 years mortgage rates go up drastically, it's not going to affect people who bought a home today, because you have a fixed rate mortgage, which means your monthly payments are not going to change. And so even if interest rates go up, the people that bought a home today, as long as they can keep making their current monthly payments, they're not going to really see any major financial hardship, because they know what their monthly payment is going to be for the next 10, 20, 30 years, assuming they don't refinance when mortgage rates are a whole lot higher. The second major difference between now and then is now you can't even foreclose on somebody who is not able to pay their mortgages. Back then, if somebody wasn't paying their mortgage, 120 days later, they were in the process of getting kicked out of their home. Now, it's not allowed by the government. And so even if this forbearance program ended and people were still not paying their mortgages, you still wouldn't see these foreclosures, because the government is not letting that happen. Third, the government is trying to do what they can to make housing more affordable. Now, what's interesting is these programs will actually end up making housing less affordable in the future, but we'll talk about that in just a little bit, because now the government is saying that they're working to pass a $15,000 first-time home buyer credit to people who want to buy their first home. So this $15,000 credit would essentially be free money to people who want to buy their first home, and this money could be applied to your down payment. Now, if that happens, then people who cannot afford a down payment would have some assistance for the government. But what that could cause over the long term is now you have a lot of people buying homes and they're getting this free $15,000. And this would cause more buyers to enter the market, which would cause home prices to go up by, I don't know, $15,000. So we don't have the same red flags that led up to the 2008 crash right now. Right now, we have issues that are a little bit different, but they're not as directly linked to the housing market as we saw before the 2008 crash. Because right now, we have a rising national debt. We have a rising cost of living, and we have rising inflation, which makes the cost of everything around us, from our rents to our groceries to our healthcare costs, to keep going up. And so all these extra costs that we have are squeezing people. They're squeezing people's ability to spend money. Now, one of the ways that they could squeeze people is their ability to spend money on their mortgages. And so this is something that you have to pay attention to, because we had an insane amount of money printing happen in 2020 and 2021. These things have a cost. All this money printing is going to dilute the value of our dollars, and that could cause home prices to go up even more. And so we could see home prices go up a lot, which could outprice buyers, like I talked about earlier. And if that happens, then you would have to see home prices eventually correct, because if you have people selling homes, but nobody's able to buy the home because they don't have the means or the ability to afford homes, then you'd have to see home prices come down to correct. Now, that doesn't mean that you see a home price crash, but a home price correction could happen if you see home prices go up way too fast. Now, everything that I'm saying right now is based on the information that's public at the time we were recording this video. If interest rates start to really go up in the future, and now people cannot afford homes, so now banks have to make changes, like maybe they bring back 0% down payments, or maybe they bring back variable interest rates, and people start to take advantage of these things because they want to buy homes. Now that would be almost an exact repeat of what we saw before the 2008 crash. This is why I said just a minute ago, equity is so important. You have to pay attention to equity, because if people have cash, they have equity in their homes, then people are not going to want to walk away. They're going to find a way to keep making their mortgage payments. They're going to do whatever they can to keep their homes, which is why you would not see a huge boom in foreclosures, which would prevent you from seeing a repeat of 2008. And this brings me to number 5. What's coming next? Well, over the long term, home prices cannot sustainably grow many times faster than wages. It's just not sustainable. And so you have to kind of pay attention to, one, how fast home prices are growing, and second, how fast wages are growing. But home prices can go up fast as long as you have this kind of influx of buyers with not enough sellers in the market. And so yes, although home prices are growing way faster than wages, this can keep happening as long as you have way more buyers than sellers out there. And there's a few different things that can fuel that. One is low mortgage rates. So if you continue to see low interest rates, that will continue to bring more buyers into the market, because people will want to take advantage of this cheap debt. Second is a low inventory of homes available for sale. So right now, we still have a labor shortage and a material shortage, which is making it harder for people to develop and build new homes. And so if it's taking longer for people to build new homes, then that could keep the inventory of homes available for sale small. But if we see a whole lot more homes getting finished and being sold and being developed, then that could increase the supply of homes available for sale, which could help kind of balance this market. And so if we have a whole lot more homes available for sale, then that could balance out the buyers, which would slow down the housing price growth. And the third thing is the economy, because right now what we've been seeing happen is a K-shaped recovery. What that means is we had some people that were really impacted in a good way by this pandemic, and these are the people that have been buying homes. These are the people that came out of the pandemic stronger, or were not hurt by this pandemic, and so they still had an income. They were able to qualify for a mortgage. They were able to take advantage of this cheap debt, and they were able to go out and buy homes. But at the same time, we had a lot of people that were hurt by this pandemic, that are not able to qualify for a mortgage right now because they lost a job, or they lost an income stream, or they saw their wages get cut. And so for the people that are working in the retail sector, or the hospitality sector, or the food restaurant sector, these people were hurt by the pandemic. And these are people that are not able to buy homes. And so if the economy starts to recover very quickly, and you see these people get their jobs back, then what you're going to see happen is a lot of these people may want to now try to take advantage of these low interest rates, because although mortgage rates are not where they were a little while ago, they're still historically low. And so if we start to see these people start to buy homes, this is a whole new wave of people that are going to want to go out and buy homes. And so we could see, if the economy recovers, a new wave of buyers enter the market, which would continue to push housing prices up, at least in the short term. So in the short term, the next 12 months, maybe 18 months, we could continue seeing the housing market boom at record levels, assuming interest rates stay low, assuming that we have a low supply of homes available for sale, and assuming that the economy continues to grow. If these three things happen, you can see the economy boom, especially in the short term. Now, over the long term, we have a lot of fundamental issues, like I talked about. We have a lot of cheap debt. We have a very high national debt. We have inflation that is growing. We have a higher cost of living. And if people are not able to afford their livelihood, if they're not able to afford a new home, if they're not able to afford their housing payments, now we could continue to see major issues in the future, which could cause a correction, maybe in the crash. Now, when is that going to happen? I have no idea. But in the short term, our housing market looks like it's set up to boom, at least based on the information that we have right now. Before we jump back into the video, I want to let you know about our Market Insiders program. If you're interested in learning more about how to invest your money in the stock market and the real estate market, and you want to have some coaching to help you do that, well, the Market Insiders program is for you. In Market Insiders, every week, you're going to get access to a group coaching lesson where you're going to learn about how to invest your money in the stock market and the real estate market. You'll learn how to invest your money, you'll learn how to find undervalued deals in the stock market and the real estate market. You'll learn how to value your investments in the stock market and the real estate market, and you'll learn how to apply what you learned into the real world, because all of these classes are live. So if 1 week in a stock market class, you're learning about how to read cash flow statements and Tesla released their earnings statement, well, for the first half of the lesson, you might just be studying how to read cash flow statements, what is a cash flow statement, how to find a cash flow statement, and then in the second half, because Tesla released the cash flow statement, you might understand and go over how to read Tesla's cash flow statement, because all these classes are live, so you can apply what you learn to the real world. Likewise, in the real estate coaching sessions, you might be going over how to invest in apartment complexes, and then if there's a new report by the Federal Reserve Bank on how they're going to fight inflation, you'll talk about how their report affects real estate prices. When I was working to create Market Insiders, there was two things that were very important to me: the coaches and the price. When you're trying to learn how to use your money, it's important that you have teachers that have actually done what you're trying to do. And that's what we've done with our Market Insiders program, where our coaches are real investors. These are people that have hundreds of thousands, if not millions of dollars invested themselves. So they're talking from real experience, from things that they've done. And on the cost side, we worked hard to make sure that Market Insiders was affordable. It costs less than the price of dinner for two. And if you still don't believe me, you can try it out for yourself. We have a free 10-day trial where you can go through the entire Market Insiders program. When you join, you'll get access to a free stock market class. You can go through that. You can go through our coaching. You can go through our previous recordings, because you're going to get access to that. And you can also go through the exclusive community of investors. So you can talk to other investors, you can network with them, you can ask questions, and you can talk about investment opportunities. So you can go through the entire Market Insiders program, and then you can decide if it's worth the money or not. This way, you really have nothing to lose. If you start the free trial and you hate it, well, you don't got to continue with it, and it doesn't cost you a penny. But if you love it, then you can continue with the program. So if you want to try out Market Insiders with our free 10-day trial and see if it's right for you, I'll put the link to how you can join our free 10-day trial in the description below. Now let's jump back into the video. The American dream is to be a homeowner, but that dream is becoming a little bit more difficult to accomplish because home prices are rising so fast. In 2020, median home prices hit a record high of $320,000. Let's do the math. Let's say you want to buy an average home. Right now, that's $320,000. And let's say it looks like this. You got a lopsided home. Hopefully your real home isn't lopsided. Let me draw you a nice mustache. So you want to buy this lopsided home and you want to pay $320,000 for it. Well, if you want to buy this home, you need to have some cash ready to buy it. Typically, you need a 20% down payment. 20% of $320,000 is $64,000. And then you need cash for all your closing costs. That's typically around 3% of the home value. 3% of $320,000 is $9,600. So if you want to purchase this home, you need to have at least $73,600 in cash ready to go in order to purchase this home. If you don't have $73,600, then you're gonna have to get a different type of mortgage where now you're gonna have to pay higher fees and you might have to pay PMI. and so it will cost you more money in the long run. But if you want to purchase this home with a typical conventional mortgage, then you need at least $73,600 in cash right now. This is what's making home ownership less affordable, because a lot of people don't have $75,000 just sitting there ready to buy their home. Right now, we are seeing home prices go up faster than ever, which is great if you're a homeowner, because now all of a sudden you have more equity in your home. But it's not so good news if you want to buy a home, because now buying a home is even more expensive. So the question we need to ask first is, why are home prices going up so fast? Once we do that, then we can dissect if home prices are rising too fast, and if home prices are rising too fast, then what can we expect coming next? I used to work as a real estate agent, and one of the questions that I would ask you if I was the one selling your home is, how much do you think your home is worth? And this was always a very interesting dilemma. You might tell me, hey Jasprit, I think my home is worth $500,000, so that's what I want to sell my home for. And this is where things get really interesting, because you think your home is worth here, but you are not the dictator of what the value of your home is. The market is. The buyers are. Because now, if you market this home for sale for $500,000, and the highest offer you get is $450,000, is your home really worth $500,000? No, it's worth what the market is willing to pay. If the market is willing to pay only $450, then your home is only worth $450,000, because that's the most anyone's willing to pay. Likewise, if you think your home is worth $500,000, and now we market it for sale, and now we get a bunch of offers, and someone's willing to pay you $550,000, are you gonna say, hey Jasprit, no, I'm only gonna sell it to them for $500,000 because that's how much I think my home is worth? No. You're gonna sell it for $550,000 because that's what the market is willing to pay. So we have to start here. Why is it that $500,000 homes are being sold for $550,000? Well, this goes back to supply and demand. If you have more buyers than sellers, that means buyers are gonna have to bid against each other to buy a home. And if buyers are bidding against each other to buy a home, that means this is gonna push home prices up. So if you have more buyers than sellers, then these buyers are fighting each other to buy a home, which is gonna push home prices up. If you have more sellers than buyers, now sellers are gonna have to fight against each other to sell their home to a buyer, so they're gonna have to cut their prices, and that's the only way you're gonna be able to sell your home, and that pushes home prices down. So when you have more buyers than sellers, home prices go up. When you have more sellers than buyers, home prices go down. Home prices are going up, which tells us that there are more buyers in the market than there are sellers. But the real question we have to understand first is, why are there so many buyers out there right now? And there are 4 potential reasons that could cause more buyers to enter the housing market. The first reason is more jobs, because if there are more jobs out there, then more people will have an income, and if more people have money, then more people are wealthy, and more people will want to invest this money into their own home. However, I really don't think that is the case right now, because right now there are millions of Americans out of a job, unemployed, so I don't think that's what's causing more buyers right now. The second reason why more people will go out and buy homes is when you have higher wages, because when people have more money, they want to invest this money back into their home, because owning a home is the American dream. However, I don't know how true that is either, because after the 2020 pandemic and the 2020 recession, the tech industry boomed, but the rest of the economy kind of slowed down, and you saw lots of people get their wages slashed, you saw lots of bonuses canceled, and you saw lots of raises put on hold. So again, I don't think we have higher wages out there, which is contributing to these more buyers out there. So people are not buying homes because there are more jobs, and if people are not buying homes because of higher wages, then people might be buying homes because of number 3, interest rates. When you go out and you buy that $400,000 home, then chances are you're not going to go to your bank account and pull out a $400,000 check and give this to the seller. For the majority of people, you are going to take a loan from the bank and use the money from the bank in order to buy this $400,000 home. And so now, after you take out this loan from the bank, you have to pay the bank back plus interest. But when interest rates are lower, that makes borrowing money cheaper. And what we saw happen after the 2020 recession and pandemic was interest rates got slashed again and again and again. This made borrowing money and getting a mortgage much cheaper, which made it more affordable to go out and get a mortgage, which incentivized a lot of people to go out and buy a home, because now all of a sudden you can borrow $500,000 for your home and pay a whole lot less money in interest. So people have been trying to capitalize on these low interest rates, which is driving more buyers into the market, which is exactly what the government and the Federal Reserve Bank wanted, because when they cut interest rates, they're trying to stimulate the economy by encouraging people to go out and borrow money and spend money, because that helps get the economy moving. And so the Fed and the government are getting what they wanted, because they wanted people to go out and borrow money and buy homes, which gets the economy moving. And so these lower interest rates have been driving more buyers into the market. The fourth thing that can contribute to more buyers in the market is what I call the X factor. And so this X factor is like external influences that could cause more buyers or less buyers in the market. And I'm going to talk about this in just a minute, so sit tight. So home prices have been going up because there are more buyers in the market. And there are more buyers in the market because interest rates have come down. But the question now is home prices going up a good thing or a bad thing? Well, it depends who you ask. If you already are a homeowner, then this is great news, because maybe you bought your home for $400,000 a few years ago, and now your home is worth $500,000. So you made $100,000 by doing nothing except sleeping in your bedroom. Money come to my house. Money come to my house. Talk about making money while you sleep. But if you ask somebody who wants to buy a home, either to live in or as an investment, then you get a very different answer. Because when you want to buy a property, then you don't want high home prices. You want home prices to crash, because now you can buy homes for pennies on the dollar. And then you want home prices to skyrocket right after you buy your home. But higher home prices make it even harder for somebody to go out and buy a home, because now you need more money for a down payment. You have a higher monthly payment, and so affording a home isn't as easy. So a booming housing market is good if you own a home, but it's not so good if you don't own a home. You see the exact same thing happen in the stock market all the time. People start talking about a booming stock market and how it's so good for the economy and how it's so good for America. But really, it's only good for people who own stocks. Because if you own stocks, then you get the benefit of a booming stock market. But if you don't own any stocks, then a booming stock market doesn't really do you any good. So home prices are booming, which is great for homeowners, but it's not so good news for people who are not homeowners, because now it's more expensive to own a home. And the reason home prices are booming is because we have more buyers in the market. And up until now, the reason we've seen so many buyers enter the market is because interest rates were slashed to near zero, which makes your mortgage more affordable. But as we exit this recession and this pandemic in 2021 and 2022 and 2023, what we will probably see happen, unless something changes, is more people will have jobs. Because if the economy recovers and more companies reinvest into their growth and more companies start and grow, we'll see more people have jobs and we will see unemployment go down. If that happens, then more people will have money to hopefully afford a home. And then if we see the economy start moving and booming again, then we could see higher wages, because now companies who have more money can reward their employees with raises and bonuses and promotions. And so now if people have more money, then they can use this money to go out and buy a new home. So in the future, we could see more jobs. We could see higher wages, which would drive more buyers into the market, which could push home prices even higher. And then we hear from the Federal Reserve Bank that right now they want to keep interest rates near zero until at least 2024. That's the minimum point that they're saying right now before they will start raising interest rates again. So interest rates will continue to stay low. So if this is the future side, we'll see more jobs, more wages, low interest rates, which could push more buyers into the market. Again, this could change, but this is what it looks like right now. And then we have to look at the X factor. So this X factor is external stimulus that could cause home prices to go up or down. And right now, at the time of me recording this video, there's not too much of this X factor out there. However, this could change in the future because of the Joe Biden presidency. One thing that Joe Biden keeps saying that he wants to do is he wants to give first-time home buyers, many of these people are young millennials who don't have the down payment ready to go out and buy a home. He wants to give these first-time home buyers $15,000 for free as a credit. That way you can go out and save money on your down payment to encourage first-time home buyers to go out and buy a home. The purpose of this program is to encourage people to go out and buy a home, which means that if this program works and if it gets passed, then it would create a new flood of buyers into the market, which would push home prices even higher. The second thing that Joe Biden wants to do is open up the United States for foreign investment. So this is something very different than Donald Trump, because Donald Trump had a hard stance on immigration and he had a hard stance on foreign investment in American assets. Joe Biden has a very different opinion. he wants to open up the United States for foreign investment, which kind of open up floodgates for foreign money coming into the United States to buy up United States real estate. If that happens, then you could see money coming from Asia and Europe and other countries around the world, and you can see this money come into the United States, especially the big cities, and this money could start buying up real estate in the United States. If that happens, now you have a whole new wave of buyers in the United States for American real estate, and this could push home prices up even more. Again, I can't predict the future. I don't have a crystal ball. I'm just telling you what we know based off of the data that we have today. All of these things can change almost instantly. I mean, if the economy doesn't recover like everybody thinks, then we are not going to see more jobs, and we are not going to see higher wages. And if the Federal Reserve Bank decides to raise interest rates faster, then we don't have low interest rates anymore. And if Joe Biden changes his policies, then this X factor is not there anymore. So I don't want you to just jump to conclusions. I want you to understand how to analyze the information. So now, are home prices rising too fast? Well, it depends what you mean by home prices. When people say it's a problem that home prices are rising too fast, what they mean is that the real problem is home affordability is going down too quickly, because home affordability is what really determines if you can buy a home or not, versus home prices are just the front facial value. So if you want to understand are home prices rising too fast, then you need to know if home affordability is going down too quickly. And the way you understand home affordability is by looking at three different things. You got to look at home prices, mortgage rates, and wages. Because when home prices go up, that makes owning a home less affordable. And when mortgage rates go up, that makes owning a home less affordable. And when wages go down, that makes owning a home less affordable. At the time of me recording this video, home prices are going up. We've already established that. And so higher home prices make owning a home less affordable. But at the same time, mortgage rates have been going down. So this is kind of converse to home prices, because lower mortgage rates make it more affordable to own a home. So higher home prices, less affordable. Lower mortgage rates, more affordable. But this is where things get even more tricky, because when mortgage rates get cut, this pushes home prices higher, because lower mortgage rates push more buyers into the market, which push home prices higher. So cutting mortgage rates make owning a home more affordable initially, but over time they can make owning a home less affordable, because that can push home prices higher than the benefit you got from lower mortgage rates. And then with wages, at the time of me recording this video, wages are not keeping up with the rising housing costs. What we've been seeing happen now over the long term is the housing prices have been growing 4 times faster than wages. So wages are going up, but just not as fast as housing costs. So we have rising home prices, which makes owning a home less affordable, and we have wages that are not keeping up, which makes owning a home less affordable, and we have mortgage rates that are going down, which makes owning a home a little bit more affordable, however, only for a little bit of time, because as mortgage rates go down, this pushes more buyers into the market, which pushes home prices up. So if we analyze these 3 things together, then we can really understand, are home prices rising too fast? In general, for the average American, yeah, they are. Your wages aren't keeping up, home prices keep going up faster and faster, and yeah, interest rates went down, which was good, but that's now pushing home prices even higher. That's why the government wants to give out $15,000 for free to first-time home buyers. That way it's more affordable for you to go out and buy a home, but over the long term, that's going to push home prices up even more, because now you have more buyers entering the market. So owning a home is more difficult now than before, because home prices keep going up while wages don't keep up. Couple that with all the new expenses that young people have, like student loans, and now it is much more difficult for somebody to be able to afford a home. That's why understanding money and financial education is so much more important now than ever before, and we have tons of videos to help you out with that on our YouTube channel. So what we're seeing happen right now is home prices are still growing very fast. It's just not growing as fast as it was before, but home prices are still rising. Now the question is, how fast can home prices keep rising like this? Because the reality is, with something like home prices, and this really goes to any asset class, but especially for home prices, if people cannot afford home prices,